Did the outlook for the global economy change as of this week?
Hey, look, Trump is really playing with fire here with the tariffs, the export restrictions, and the currency manipulation designation. So everybody's looking at the growth outlook. We've taken 0.3% off of our China forecast for the next year, and we have seen about $10 billion of outflows just last week from emerging markets assets. So, changes to the exchange rate forecast and changes to the growth forecast. It's this kind of uncertainty that will also prevent investment flows from coming in, investments in CapEx as well.
So President Trump is speaking right now. We're just getting some headlines coming from, I guess, outside the White House. He's saying Trump says going very well with China, but not ready to make a deal. He says he has no choice but to do what he's been doing on China. He's still talking to China and still says that we will meet in September, and then talks a little bit about monetary manipulation. Joyce, where is the market in terms of expectations for a trade deal, and by when?
I think a comprehensive trade deal is just not going to happen. I think from the Chinese perspective, once they saw that after Mexico had signed an agreement that Trump threatened the tariffs, they basically said, what is the point of a 150-page agreement if it can be invalidated like this? So I think it is much more transactional at this point in time, and it will be focused on what will happen specifically with Huawei, then what will happen with the September 1st deadline, rather than thinking you can get a comprehensive deal at this stage.
I mean, given all these risks, are you surprised to see such a sharp rebound in the stock market this week?
Well, there is a tremendous amount of policy support from central banks all around the world. So we have 19 central banks in total in our count who are easing right now, and we expect China to do 2 more triple R cuts itself. So it's that kind of liquidity that is supporting the market right now, but you're going to see the volatility persist.
Jurrien, are you with us?
Yes, I'm here.
Your take
clearly
on the price action, given the higher escalation risks around trade this week.
Yeah, clearly volatility has returned, and it's always, a two-way street. The market was down 7% at the lows earlier this week from the recent highs, and obviously we've had a bounce. And my guess is that kind of price discovery will continue. Last year, the S&P was generating earnings of 22% growth against profit margins of 20%. This year, we're at 3% growth, looks like, for the year, and maybe 19% margins, but still a 17 valuation. But I think probably one of the key things that I think brought buyers back this week was that the market actually was cheaper than it appears. The equity risk premium actually was at 4.5% a few days ago, which is where it was in December when the S&P was actually down 20%. And so the reason that it's so high now is because obviously bond yields have crashed to 1.6% earlier in the week. And so the relative valuation for the stock market actually looks a lot better than just by looking at the PE. And I think maybe that's what brought some buyers back in.
Jurrien, that certainly implies a cushion for stocks if the crash in bond yields, as you describe it, is not foretelling something much worse. So in other words, if recession risks have ramped higher, it's hard to know whether that equity risk premium represents an opportunity, I guess, at this stage.
At this point, now that the Fed has fully pivoted towards easing, maybe not as much as the market would like, it really does become a recession call, right? If this is a recessionless Fed easing moment, and you and I have talked about this in the past, 95, 98, then clearly the market is a buy. But if this is the beginning of a recession, then it's not, because then you're going to see an earnings contraction. But what it does show, that this juxtaposition of bond yields and the stock market, is that some sort of 60-40 balanced portfolio has really served investors well, not only in the last couple of weeks, but really the last couple of years. And I think as long as investors are exposed to both asset classes, one kind of makes up for the other.
President Trump continuing to talk about how it's the Fed's fault. They should be lowering interest rates to weaken the dollar. He now is calling for a full percentage point decrease in terms of interest rates from the Fed. What's the likelihood of that, Joyce?
Oh, I don't think that's likely at all. But if you take a look at negative yielding debt in the world, we're up to $13 trillion right now. So there isn't that much more ammunition that you can really use at this stage. Look, the U.S. economy still is in a relatively reasonable place. I don't think that cuts of that nature are in order at this stage in the game, or that likely.
But it sounds like you still like the market despite all of this because of this wave of easing.
Well, this wave of easing, I think the relative valuations, given where bond yields are at, and also the investor positioning not being as problematic as it had been last fall. So I think you stay in this range. I think it's hard to break out of this range until you see more clarity on some of the trade issues, the issues that are related to the specific deadlines that investors are looking at. They're right now focused on the September 1st deadline and what announcements will come out of Huawei specifically on allowing some of those sales to go forward, and whether that then will mean you could see more progress at the next meeting they have in September.